Hi, I'm Yu Pham. Today, my topic and that I'm talking about is short selling. I will briefly explain what it is, why it matters, and how it connects to arbitrage in a simple way, even for non-finance audiences. So let's start with the basics. So normally, when we invest in stocks, we follow a very simple rule: buy low and sell high. We buy a stock, wait for the price to go up, and then sell it for a profit. Short selling flips the logic around. In short selling, the investor believes that the stock's price is going to fall, not rise. So instead of buying the stock first, the investor borrows the stock from the broker, then they sell it immediately at the current market price. At this point, the investor doesn't actually own the stock, they just owe it. Later on, if the stock price actually goes down as expected, the investor buys the stock back at the lower price, returns it to the broker, and keep the difference as profit. For example, imagine you borrow a stock from broker for $100. A few weeks later, the stock price goes down to $70. You buy it back at 70, return it to the broker, and then you earn a profit of $30. However, if the price goes up instead of going down, say it rises up to $150, in this case you still have to buy it back to return to the broker, and you will lose $50. So this leads to a very important point here. Short selling has limited returns since the stock price can only go down to zero at the minimum, but it carry unlimited risk because the stock price can go unlimitedly. We will not know how high a stock price can go. Actually, the concept of short selling is not a new. It's not new. Um, it dates back more than 400 years ago. One of the earliest short sellers was Isaac Lemaire, who traded shares of the Dutch East India Company. He believed that the company's share were overpriced, so he sold shares that he didn't own and expecting the price to fall. Even though markets today are far more complex compared with the with 400 years ago, but the core idea behind short selling is exactly the same. Talking about the roles of short selling in the market, first it helps correct overvalued stock price by allowing negative information to be reflected in the market. Secondly, short sellers often conduct deep research so they can expose weak business models or even fraud. And thirdly, short selling also used as a risk management tool, especially by professional investors who want to hedge their portfolios. So at the same time, it can increase volatility, uh, which is why short selling is sometimes controversial and is clearly regulated by the government. So for short selling, we don't need to invest money. We can make profit out of it. So a very common question here is short selling an arbitrage opportunity? So as we all know in our course that the arbitrage opportunity include three essential characteristics. The first one is it requires no initial investment. Secondly, it guarantees a positive return, and finally it is risk free. So now if we look at the short selling from a fundamental perspective, it actually fits some of the conditions, but not all. Um, in theory, short selling requires no initial investment because the investor borrows the stock instead of buying it, so we don't need to invest any money. It can also generate a positive return if the price actually goes down as expected. However, the key condition that is clearly violated here is the risk-free element. Short selling is actually a very risky because prices are uncertain and can rise sharply at any time. So in reality, short selling is not an arbitrage by itself. It is essentially a bet on price uncertainty rather than a risk-free profit. However, short selling can become a part of an arbitrage strategy when combined with another position. For example, if a stock is overpriced compared to its future contract, a trader might short the stock and buy the future at the same time to reduce the risk element of the short selling in security. A very famous reward example is the GameStop short squeeze in 2021. A short squeeze occurs when rising prices force short sellers to buy back shares, further driving the prices upward. Back then, for GameStop, many hedge funds believed that GameStop, at that time, is a traditional game distributor. It was a declining business. So they heavily shorted the stock. However, retail investors began to buy the stock aggressively, pushing the price to go higher and higher. And as prices rose, short sellers was forced to buy back shares to limit their losses, which pushed up the price even more. So this event clearly show how risky short selling can be when market sentiment turns against you. To sum up, short selling is a way to profit from falling prices, and it helps market function efficiently, but also carries significant risk. Thank you for listening.